A lot to go through in this statement. There are multiple press releases here, including an exit strategy, but the bottom line is the statement does not include any major changes to the forward guidance here. That's a dovish signal within this statement itself, but you look at the forecast for where interest rates are going, and there's some contradiction there. Fed policymakers do see rates at a higher level in 2015 and at the end of 2016 than they had previously. Again, there's a separate statement on the Fed's exit strategy, other technical data to go through as well, so a lot to pour through. First of all, in the statement itself, the bond buying will come to an end, according to the Fed, if incoming information broadly supports the committee's expectation of ongoing improvement in labor market conditions and inflation moving back towards its longer-run objective. The committee will end its current program of asset purchases at its next meeting. However, asset purchases are not on a preset course. That line remains in there. But the statement goes on to say the committee continues to anticipate, based on its assessment of these factors, that it is likely it will be appropriate to maintain the current target range for the federal funds rate for a considerable time after the asset purchase program ends. So that line remains in there as well. A lot of speculation as to whether or not the Fed might remove that forward guidance. And again, this statement goes on to say, again, repeating, the committee currently anticipates that even after employment and inflation are near mandate consistent levels, economic conditions may for some time warrant keeping the target federal funds rate below levels the committee views as normal in the longer run. So that long-range guidance remains. Now, with regard to the economy, there's some new language here, some new concerns about inflation, for example. But first of all, since the committee met in July, the information received suggests that economic activity is expanding at a moderate pace. On balance, labor market conditions improved somewhat further. However, the unemployment rate is little changed, and a range of labor market indicators suggests that there remains significant underutilization of labor resources. So that language, again, remains in the statement. Here's the inflation language that's new. Inflation has been running below the committee's longer-run objective. Longer-term inflation expectations have remained stable. So again, inflation, low inflation, still on the Fed's radar. There were two dissents here. Charlie Plosser once again dissenting because he did not like the considerable time language remaining in here. And the other dissenter, Richard Fisher of the Dallas Fed. President Fisher believed that the continued strengthening of the real economy, improved outlook for labor utilization, and for general price stability, and continued signs of financial market excess will likely warrant an earlier reduction in monetary accommodation than is suggested by the committee's stated forward guidance. So two dissents over the forward guidance. Let me walk you through right now, again, the forecast and what's changed here. And I'm going to have to hold this up so people can see it. Hopefully you've got it on screen as well. In 2015, 14 Fed policymakers now believe we'll see the first increase in interest rates. That's up from 13. You got to remember, there's 17 policymakers total. We don't know who these 14 are. Separately, down here, more importantly, this is where Fed policymakers believe the Fed funds rate will be at the end of the calendar year. 2015, a few months ago, the median figure was 1.13%. Now, 1.375 is the median, so that's moved up higher for 2015. Separately, 2016, the number has moved from 2.5% to 2.875%. So again, Janet Yellen's going to have to explain why those numbers are creeping up, and does it reflect outliers, or is the consensus view still consistent with where we saw in June? The exit strategy release, Mark, I'll just tell you, interest on excess reserves will be their primary tool, as we know. Separately, they will use as a floor the overnight reverse repo facility, but reinvesting proceeds from the Fed's bond holdings will only end after the interest rates start to move higher, and the Fed will make it economic contingent. They will look at the data to determine if that reinvesting should come to a close.